Hi, I'm Scott Weiss, Certified Financial Planner at Weiss Financial Group. In this presentation, I'll be discussing our investment process. The investment strategy we build is simple but powerful. Our philosophy is to win by not losing. The portfolios developed are managed on spreads between up captures and down captures. That is, we aim to capture a greater proportion of the market's up movements while minimizing capture of down movements. We believe that over a longer period of time, this method of investing will help investors keep emotions under control, thus keeping assets invested and avoiding capitulation. The core of our investment strategies is based on the idea that avoiding a market precipice is essential to success, because the less the investor loses during downturns, the less they have to make up when the market rebounds. The promotion of growth in our portfolios is always important, and protecting against full participation in downward moves serves this objective. Before we proceed, allow me to read some disclosures. The following presentation includes a detailed analysis of our investment strategies. This analysis provides detailed information that will allow us to show the mechanics of our investment process. In addition, we will illustrate a customized search, illustrate the results, and how we monitor investments going forward. By evaluating such institutional statistics such as MPT statistics, style specificity, expenses, fund holdings, and a universe of sophisticated data, we're able to make better informed choices for our clients. The time frame for each analysis may differ by asset category as a result of varying inception dates of the securities monitored. Reviewing both holdings-based and performance-based statistics enables us to gain a better picture of the securities being utilized. Our information has been extracted from Morningstar data fields and deciphered through the institutionally based system Zephyr Style Advisor. Please note that Morningstar utilizes a holdings-based approach to viewing the investments, characteristics of the fund/sub-account's actual holdings to determine investment style, whereas Zephyr Style Advisor relies strictly on performance as its measure of analysis. This is defined as returns-based analysis. Each security analyzed in this system is positioned relative to the appropriate index with respect to style, risk, return, and performance. Please understand that this information is for comparison purposes and is not intended to serve as investment advice, nor is it a recommendation of any of the investments reported in this material. It is suggested that this analysis be used in addition to other tools you might already be using. As always, past performance does not imply the future performance of any investment used throughout our analytical process. At our firm, we firmly believe that one of the keys to the implementation of a successful strategy starts with a well-defined process. The process is comprised of 3 steps: manager selection, asset class and manager optimization, and ongoing review and monitoring. Step 1, manager selection. With so many investments to choose from, how do you identify the managers you want in your portfolio? First, our firm utilizes returns-based style analysis to screen over 20,000 investment options, including mutual funds, ETFs, separately managed accounts, and hedge funds. From those meeting our criteria, our research team utilizes over 30 quantitative filters to identify those managers that display similar characteristics of the overall investment philosophy of our firm. A few of these characteristics include, but are not limited to, A manager's ability to consistently provide excess returns above an appropriate market and style benchmark, B, provide better risk-return characteristics versus an appropriate market and style benchmark, C, the demonstration of better performance in down market moves, and D, the investment company's ability to comply with all quantitative measures deemed appropriate by our firm. We conduct further in-depth analysis using these criteria: style analysis, trailing returns, calendar year returns, risk return analysis, due diligence compliance, up-down capture, excess return features, manager versus universe. We demand that every investment vehicle we recommend are in compliance with all regulatory agencies and are conducting managerial services in compliance with their prospectus. Our criteria include regulatory oversight, minimum track record, assets in the product, expense ratios and fees, stability of the organization. The investment characteristics we are looking for include the ability to provide excess returns above their designated benchmark, relatively low tracking error, the standard deviation of excess returns are low, high significance level, a confidence level that the manager will continue to provide excess returns, the manager is providing style consistency, the manager is a top performer among its peer group, and the manager has complied with all due diligence criteria. Step 2, asset class and manager optimization. The portfolios are built based on two essential components. The strategies begin with efficient frontier theories and are overlaid with a tactical component from our investment committee. The research team utilizes the efficient frontier classical portfolio theory used by many investment managers in their asset allocation decisions. According to the theory, whenever an investor has a collection of diversified, uncorrelated assets, an efficient frontier can be built. This model attempts to pair various asset classes together to optimize risk and reward potential. The investment committee provides further enhancement to the traditional efficient frontier theory by utilizing the Black-Litterman modeling system that provides two distinct differences. This modeling system provides the capital asset pricing model theory that allows our firm to incorporate more asset classes in our modeling system. And B, Black-Litterman also provides our investment committee the ability to provide a tactical component to our strategies that allows us to focus and manage based on current economic conditions. As illustrated here, creating the efficient frontier curve using the Black-Litterman model allows us to find optimized allocations for the different levels of risk. Step 3, ongoing review and monitoring. With actively managed portfolios, the ongoing review and monitoring is critical to keep investors informed and investment strategies updated to address today's ever-changing market conditions. Our firm conducts daily, weekly, monthly, and quarterly updates to constantly ensure our investment strategies stay on track with A, financial goals and preferences of investors, B, regular rebalancing to maintain the proper allocations, C, ongoing adjustments to our models and strategies based on the investment committee's view of global markets, and D, forward-looking, proactive, institutional investment research. We offer quarterly reporting to ensure that each investment is in compliance with our risk-return expectations. The search process will be conducted quarterly as well to find backup investments for any investment failing to meet the goals of our portfolio. We see here a copy of a one-page fact sheet which is updated monthly. With a strong focus on risk-averse investing, we aim to deliver satisfying results with a more comfortable investor experience than traditional buy and hold strategies, which are often susceptible to severe swings as they capture large portions of negative as well as positive market movements. At our firm, we accept the possibility of missing some of the upswings in order to minimize downside risk. Our investors have benefited from the use of low and negatively correlated asset classes and money market positions to help manage downside volatility. And because we rigorously follow our model, investors know what to expect from us.